Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be taking a look at our proxy for the S&P 500, which is the SPY ETF, and there's a few things I want to talk about today. We're going to look at the Elliott wave count, but we're also going to spend a bit more time looking at some basic technical analysis, some market geometry, and I also want to finish the video by looking at the monthly chart because there's some really interesting changes and bearish signs which have occurred on the monthly chart, which we haven't seen since the meltdown in February 2020. So we'll have a quick few minutes looking at that at the end of the video. But first, let's just do a quick recap of where I think we are with the Elliott wave count. I think we've completed a wave 3 up here now. I'm saying primary degree because our pivot off of the primary 1-2 seems to fit what we've done so far in this correction, but I'm starting to suspect that this will either be a deeper correction which will break this trend that we've been in. Let me just show you what I mean when I refer to the pivot off of that wave 1-2. If we take the pitchfork here for a minute and we just zoom in, and we'll just turn the count off for a moment and then we'll come back to it once we've discussed this. So you know, taking the primary 1-2, this is what we're saying is our wave 1, which was the high back in 2nd of September last year, and you know we bottomed in 24th of September last year, and so this was our wave 1, wave 2 pivot, and from there all price action has retained and stayed within this pitchfork. You know, we've traded mainly, we've spent most of our time channeling between the 38.2 upper bound and the 38.2 lower bound. It's basically all in between this green line here and you know, this green line here, and a lot of, you know, interaction with and around the median line the whole time. So we have had exceptions where we've gone higher, we've gone lower. We haven't come up to an extreme of the pitchfork. We had this initial 1-2 pivot at a lower wave degree. Obviously this didn't actually come to a lower low, this was a higher low than this low, so we didn't end up using this as our pivot, we used a lower low as a pivot and assumed that this was a wave 1 and a wave 2 of a smaller degree, and we worked our way up into a wave 3 at the same primary degree. Well, what's interesting is we had a clear 3 wave move down to the outer bound, and here we found support and we had these 3 lows, okay, and didn't body the candle below. Oh sorry, let me just move the chart back and get rid of that. Alright, let's try that again. So we had these 3 lows down here that would not body the candle below the outer bound of the pitchfork, and we had a wick down and a wick down, but we wouldn't body the candle outside of this thing, outside of this market geometry. So this has been playing a role the whole time. But what's interesting is the move back up does not so far look impulsive, it looks corrective. So going back to the Elliott wave count for a moment, excuse me, there we go. Going back to the Elliott wave count for a moment. Okay, so I'm starting to suspect that this 3 wave move here wasn't the completion of the correction. I mean, we can say maybe it is A, B, C done. The problem I've got with this is that would have to count as a zigzag, and we've got a zigzag back here at primary degree wave 2. Now our corrections 2 and 4 are all wave degrees, or within the same wave degree I should say, should alternate with one another. So where you see a flat, you might see a zigzag. Where you see a zigzag, you might see a double combo. Where you see a double combo, you might see a triangle in the 4th, and so on and so forth, and you get that kind of alternation. Obviously the example of a triangle can only ever occur in the 4th wave of an impulse, or in, you know, other corrective structures such as B waves and X waves. But either way, if we were going to see it, we would see it in the 4th. So my point being that it doesn't look like a typical correction that's alternating with the wave 2. It's either a zigzag, and if it is a zigzag, then we call into question the degree of labelling we're at, because if it is a zigzag, it can't be a zigzag at the same primary degree. It would have to be a wave of lesser degree, in which case the primary 3 isn't in, and with it, this is a 3-4 at intermediate level, and we've got another thrust up before we even find the primary 3. Now, that's not what I'm saying at the moment. What I'm considering, given the move off of the low not looking particularly impulsive, we'll come in and have a closer look at that momentarily, is that perhaps the first 3-wave move is an ABC into a W. So a zigzag joined perhaps to another zigzag, and we'll actually get a much deeper correction which will break trend. So that pitchfork, although we often see all future price data at the same wave degree held within it, there are occasions where that's not the case, and this is why we still have our Elliott wave rules to observe. For example, the invalidation point, okay, which we should have here, invalidation. Okay, so one of the rules in Elliott wave is in an impulse, the wave 4 cannot come back below the level of the top of wave 1. And that's our invalidation point all the way down here. Okay, so that's a long way and a lot of room for wave 4 to potentially correct. Now, I don't think it would go that deep. It would just seem like any market geometry would seem completely broken at that point to have such a deep 4. But what I find curious also is the wave 3 is not longer than the wave 1. It's shorter. Now, this is not a problem, because the wave 3, although often the longest and the largest of waves, it doesn't have to be. It just can't be the shortest of all the waves, of all the motive waves, the 1, the 3 and the 5. So this puts an upper limit on the wave 5. If this is complete, it means the wave 5 cannot possibly be longer than the 3. Otherwise this would be an invalid count. Now that doesn't really matter regarding the long-term picture, because that wave 5 could still be huge. If you take the size of the whole length of our wave 3, for example, and project it from even our more extreme potential correction of a double zigzag, then we could still end up here at 540 on the SPY. Okay, so 5,400 on the SPX. So that could still be an absolutely gigantic move, couldn't it? So a perfect opportunity to get into a wave 4 and enjoy that big ride up, and that would be 100% parity. Now, any move beyond that would invalidate the count, because the 3 would now be shorter than both the 1 and the 5. So just because we've got all of this space, okay, all of this potential space for a wave 5, does not mean it will happen. It's a limit, not a target. Okay, it's, like I said, it's a limit, not a target. So what do we know about wave 5s? Well, in the case of the shorter, like I said, the shorter wave 3, the wave 5 now has that limit. But as a rule, the wave 5 doesn't need to come to that limit. All it needs to do is just clear the high of the wave 3. I mean, technically it doesn't even need to do that. It could truncate and finish below the top of the wave 3, but that would be quite a rare occurrence. So all we need to do is just get back above the top of this 3, and that could be a 5. Now I think that would be pretty odd, given the time of each of these waves that they've occurred over. I'd expect to see a more substantial 5. I don't think it will necessarily come to the limit, but I think it would be a little bit more substantial than that. So now let's come into the shorter time frame and have a look at this move off of the low, because this is what's got me a little confused, because this is a pivot that you'd probably want to buy, right? Because we've come down to the bottom of that pitchfork. Now the problem we've got here is it looks like 3 waves all day to me. That does. That looks like 3 waves. That does not look like 5 waves into a pivot, and then 3 waves into a 2, and then at the beginning of 5 waves up again. The other thing is we've got this overlap, right? So we can't say 1, 2, 3, 4, right, as an impulse. I don't think this is a clear 5-wave structure. If I wanted to say 1, 2, 3, 4, then I should be able to pick out a clear 5-wave move here, and I can't really seem to do that. So what I think we've got is a zigzag. Okay, now it could even be, let's just check the retracement of this, because we could be looking at a flat pattern here as a corrective pattern. We don't quite make it to the 90%, the 89%, so it is a zigzag, I think. So you're going to have a 5-wave move in here, a 3-wave move in here, and then a 5-wave move in here as an A, B, and a C, rather than 1, 2, 3, 4. We've overlapped here, so I don't think it's 1, 2, 3, 4. Could it be a diagonal? It would then have to be a series of 3 waves, 3 waves, 3 waves, 3 waves. Typically, leading diagonal could resemble an impulse. It doesn't have to have this overlap. So, hence you can see why it's a little tricky. It's a bit early to tell what it is, but it's certainly not a nice, clean impulse wave, is it? It doesn't resemble that. Right, because if we just come up and gone 1, 2, 3, 4, 5, 1, A, B, C, 2... brilliant, we'd all be much more confident that we'd bottomed here. But this looks like a 3-wave swing off of the low, not a clean impulse. Now we're trading in the pre-market slightly below yesterday's close currently, but it's a fair few hours until market opens at the moment, so a little too early to say. So perhaps there's a further move up to backtest this trend. Maybe that's an option here, to come back to backtest this trend. See if we get maybe some kind of believable diagonal pattern, although I have my doubts. So for the meantime, I'm thinking that we've had 3 moves, and now we're probably going to get another 3 moves to complete this double zigzag idea. Now we have to bear in mind though that we have just come straight to the edge of this pitchfork, so for as long as these lows hold here, we can't be particularly confident in this bearish interpretation, because we've put in the bottom at a significant point and we've bounced. We just haven't bounced in the most convincing of impulse waves. So at the moment it's just a suspicion that I have. So now let's look at some target levels we were expecting to reach. Okay, so these are all based off of the length of the primary wave 3 from the bottom of the primary 2. We have a 23.6% retracement, 38.2 and 50. We've got 422 spot 86, 403 spot 08 and 387 spot 27. We haven't made it to any of them yet. We haven't even touched the 23.6, which would be an extremely shallow correction regardless. In any circumstance it would be a very shallow correction. Now the market has been extremely bullish during 2020 and 2021. So perhaps we don't need to make deeper retracements, but there are clues that I want to look at in the basic technical analysis that I think you might find interesting. So for the moment we had what looks like this expanding ending diagonal into a 5 over 5 over 3, and then we've come down in 3 waves. This should be a minor degree, excuse me. And now we've seemed to have a 3-wave move here, but it could be something else. So we want to see if we continue to impulse higher. Okay, we want to see if we get some kind of impulse wave or some kind of diagonal and then a retracement. But I just got this suspicion that we're not done yet. Just doesn't feel quite deep enough. If we break trend and head into a deeper 4, then the invalidation point is all the way back down here at 359 spot 04, which is a long way away. So I don't see us dropping another, where are we, yesterday's close. We'd have to fall another 17.4% from here. I don't think that's likely given the way the market's performed over the last 24 months. We've only fallen 6% so far. It's really crazy actually when you think about it, because there's been a lot of fear in the retail sector. I've noticed VIX hasn't spiked, so there hasn't been panic. But a lot of the people I've come across or who I observe in the retail sector have been quite shaken up by this 6% pullback, and they've got genuine questions about whether or not this is it. But I suppose if you've only ever gone up for the last 24 months, and the only thing you've known, the only time you've been trading in your life is in the last 2 years, then a 6% pullback can be quite scary, I suppose. But of course, this is nothing. This is absolutely nothing. 6% is barely noticeable. In terms of the long-term moves and long-term crashes and big moves we've seen throughout hundreds of years of the stock market. So this is not even correction territory yet. It's not even 10% yet, which is where the media starts calling it a correction. A bear market is when it reaches 20%. These are silly definitions in my mind, as it's more about the structure of the price action which determines whether it's bearish or bullish, rather than an arbitrary figure based on a percentage. That just seems stupid, but whatever, that's the definitions we tend to use. Anyway, so now that we've covered the Elliott wave count, we'll wait and see what happens here. Does that pitchfork break? Do we come down to these levels? Do we continue to impulse down? If so, I think this double zigzag got a shout. It would provide alternation with the simple zigzag we had in primary 2. So there you go. So now let's get rid of these levels, get rid of the count, and we'll talk about some basic technical analysis for a minute. And I'm going to start on the monthly time frame because there's some interesting things I want to point out. We don't often look at the monthly time frame. So let's just alter the chart. We've got rid of our count now. Okay. So I'm going to bring up the momentum indicators as well, and there's a few things that I think are notable or noteworthy. So, first thing is this monthly engulfing candle. This is the first bearish engulfing candle we've had since the collapse down in March 2020. We had these two candles here, we had this candle here, but we closed the week inside of the previous candle. Okay. And although we broke the lows of the previous week with this candle, we don't have a full-bodied candle here doing it in a single month. We didn't gobble up this whole candle in one move. But here we've got a candle which not only closed at the lows with no wick to the downside. We had a big wick here at the downside, right? We had a big wick here at the downside. We've had all these lower wicks. Right, we didn't get one here in September. We got a close at the low, which shows no buyers coming in at the end of the month. No strength at all in attempting to reverse this engulfing candle, which gobbled up all of the previous month's price action, swallowed it whole. So that's quite bearish, and the first real bearish sign we've seen on the monthly chart since March 2020. So could this be a more significant pivot? The next thing I want to look at is we're back into overbought territory on the monthly RSI. So we weren't in overbought conditions in January 2020 before the market had its big 20% plus sell-off, or it's more than that now, isn't it? If I remember. Let's have a look. Yeah, it was like 35%, wasn't it? So we weren't even overbought then. We were overbought going into 2018, and then we had this whole sideways corrective period where we had this flash down in 18, then we had taper tantrum here, and then we had the coronavirus here. So this is the first time prior to any extended period of correction that we've reached overbought conditions on the monthly time frame. So since back in basically 2018, and when we started setting a series of lower highs in the RSI and higher highs in price, which led to this big crash, right? So that was a multi-month, multi-year divergence which built up before it was resolved. Now there's no such divergence currently. Okay, so this is one of the things which has me suspect that this is a 3, and this will go into a 4, and then we'll go into a 5, and this will then give us divergent highs. So a high here and a lower high here, ready to create divergence, ready for the big collapse. Okay, so we don't see any divergence on the monthly time frame, but we are in overbought conditions for the first time in a long time. The next thing I want to point out is on the MACD here. We've got declining momentum for several months now since June. We've got nice bright green bars, the average heading away from the signal, blue line heading away from the orange line, and then we've got darker green bars on the histogram in constant decline here. Okay, so now it's not always the case, but if we look at the RSI, as a rule, you get momentum comes in waves. So we come up into a wave, it dies over time, then we become bearish for a bit, and we go into red. We come up into a wave, then we come down, and we become bearish for a bit. We come up into a wave, we come down, and we become bearish in momentum for a bit. We come up into a wave, and we come down, and we become bearish for a bit. Now we haven't got red bars yet in the histogram here. So are they coming? You know, is that something we're going to see soon? Declining momentum. The average is starting to roll over. We haven't got a cross yet, but it's something we want to be looking for here on the monthly chart, because it would be the first time on the downward since the crash in 2020. We've seen just an expansion of the average away from the signal line this whole time since the March 2020 low. So are we going to get the first crossover since that March 2020 low? Are we going to get some bearish momentum build up here? Now, the other thing I'd point out, just looking at the MACD here for the moment, is just how far away we've gotten on the monthly time frame from the zero bound. So let's just pop a line here on the zero bound, right? As you can see, going back, this goes back to 1994, we have a period above the zero bound, and then we have a period below it. We have a period above it, and then we have a period below it. And now we've just had this period here, you know, and this is going all the way up from the end of the GFC. So this is why there's still a lot of room left. The idea that we've got 3, 4, 5, maybe even 3, 4, 5 on a smaller wave degree, 3, 4, 5 on a larger wave degree, because what we've got to do during the next bear market is this, right? Now, it doesn't matter whether we come down like a meteor or whether we come down gradually and grind lower over a decade or so and have a really sustained bear market once this bull market is finally over. But eventually, we are going to come back below this zero bound. We're going to come back below the zero line. And looking at the scale of momentum that we built up here, there is some serious correcting to do. And once the trend begins, once we get a downward trend in the price action, and maybe it's, you know, divergent high, divergent high, divergent high, while we go 3, 4, 5, 3, 4, 5 perhaps, right, and continue to head higher into next year, possibly, maybe that's when we'll start seeing a series of divergent highs here with price, the same as we'd expect to see with RSI, just like we saw from 2018 all the way up until the crash in 2020. We saw a couple of years of divergent highs. Now, I'm just talking aloud and just thinking, okay, I'm not saying any of this is certain, I'm just pointing out that a return back below the zero bound here is inevitable. It will occur. Okay, when? Nobody knows exactly, nobody can call the top exactly. So, interestingly also, is we haven't reached oversold conditions. Right, so the red line is overbought, the green line is oversold. On the RSI, we haven't reached oversold conditions since the GFC. So, the bottom of the GFC back here in 2008. So we will do this also. So whether we get 3, 4, let's assume the idea just for a moment, 3, 4 at a smaller degree, and I need to relabel, and I've got the wave degree wrong. 3, 4 at a higher degree, 5 at a higher degree, right? Maybe then we'll get lower high, lower high, lower high in the RSI, and we'll have a big downward divergence, and then you'll get the implosion, which will bring us back below the zero bound in the MACD and all the way to oversold conditions for the first time since the last bear market, since 2008, 2009. It's just me thinking aloud. There's also the possibility, right, because this is the longest bull market we've ever had. You know, it's been going on since 2009 onwards, and it's now 2021, coming in on 2022 soon. So very, 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 very long bull market. Everything returns to the mean eventually. That's just a mathematical certainty of the universe. All things return to the mean. So when's it going to do it? You could, if we're going 3, 4, 5 as my primary counter specs, and we're 3, 4 here, then the collapse required to bring us back to oversold and bring us back below the zero bound on the MACD on the monthly time frame, there's only two ways you're going to do it, right? We've discussed this multiple times in videos before. What you don't give up in price, you give up in time. You know, we've seen a shorter term example of this in the IWM with the ranging in the Russell 2000, right? What you don't give up in price, you give up in time. So we will either march down over a multi-year correction like back in the 1929 to 1933, late 32 crash, where we had an initial shock and then we meandered down over a couple of years, right? I think that is the more likely scenario when correcting a long-term trend like a multi-year bull market, or you will just have an implosion. Just an absolute implosion. Now, I don't find that likely given the scenarios we live with today, where we've got obviously massive central bank interference and intervention. The market's only allowed to fall so much in a day before the circuit breakers switch everything off anyway. So it's not like in 1929 or 1987 where the thing can just fall 22% in a matter of hours. That's literally not allowed nowadays. That would hurt too many vested self-interested parties. It would hurt too many friends of powerful people. We can't have that happen now, can we? So that kind of correction will never occur again, because it literally can't. The machines just switch off if that's a threat. But that doesn't mean that when they switch back on, the market can't sell off 5% in the futures, and then sell off another 10% the next day, and then sell off 5% in the futures, and then sell off another 10% the next day, and just keep doing that. Now, when that bear market comes, you will have big downward moves, but you'll have ripping rallies, because we know Elliott, the markets are Elliott waves. So we could have deep twos, we could have violent downward three, we could have timed consuming and frustrating wave fours, we could have thrust down again to finish it. So we'll have these huge rallies, and from experience and observation of previous bear markets, every time a significant rally comes, everyone will be shouting the bottom. Everybody will be screaming, "That's it, the bottom's in." Especially Jim. I don't need to mention his second name. You know who I'm talking about. Jim will be calling it every time we get a green day, that the market will have bottomed. So I don't want to waste too much more time now, because I've been chatting for ages. So let's just bring up our moving averages and move to the weekly time frame here for a moment, and bring up our volume profile here, and bring up our exponential moving averages. We've got 10 in yellow, 20 in blue, 60 in orange, 250 in green. So we're sat at the moment around the 20, and we're kind of determined not to break it. Just like this coincides quite nicely with the bottom of the pitchfork we were talking about, where we don't want to go through that pitchfork. The market wants to hold this level because it's significant. This is significant support level at the 20 exponential moving average, and around the geometry we've set up for the market here as well. We don't really want to break this level, but if we do break this level, then we're not done. And if we take out these lows, then we're not done. And it's likely that we've got a zigzag connected to a zigzag. Alright, and we're going to go deeper. So we're nowhere near the 60 exponential moving average on the weekly time frame yet. So let's just move back a little bit. The last time we broke through this was during the crash in 2020. We haven't tested it since on the downside in a bearish move. We've tested it as a back test in a bullish move, but that's different. That's finding support on the way back up. We're talking about, will it act as support on the way down? Okay, we won't know unless we get there. Alright, so on the, let's just turn off this labeling now, because it was only really relevant on the monthly time frame. And let's turn off this signal, this little sign we've got going on up here. Right, so we've cooled off from overbought conditions here in the RSI and the weekly time frame, and we've got a lower reading here in the RSI than we've had since the move down in October last year. So we're obviously in a significant correction. All the little moves inside here, corrections inside here, this is a smaller wave degree, because nothing in here has broken the 20 exponential moving average or moved down to a lower level in the RSI. Okay, so all of this is a smaller wave degree than whatever this is. So the only question is this related to this? Is this the same wave degree? Is this 1, 2, this 3, 4? Well, the pitchfork says it is at the moment. The price action seems to suggest that it is, but the Fibonacci extension suggests that it isn't, because we haven't had a longer wave 3. We haven't had that extended wave 3 looking for 123.6, or 161.8 extension of wave 1. We didn't come anywhere near it. We didn't even make it to 100%. So in many ways, price action resembles the same wave degree, and in wavelength it doesn't resemble it. So it's just one of those curiosities. Now, as we come down on the MACD here, we are on the weekly time frame. We've still got a long way down to the zero bound here on the weekly. Now, we haven't visited, once again, we haven't visited the zero bound here on the MACD since that breakdown in March of 2020. But as you can see, momentum the whole time here, apart from this initial pop. Okay, we had this initial pop here back in June 2020 through to September, but since then momentum's just been declining. You know, we've had a negative period, positive period, negative period, positive period, bigger negative period, tiny positive period, bigger negative period. Okay, and then we've recently had this move here, high and lower high. So we have been losing, slacking off the bullish momentum this whole time while the market's been pushing higher and higher and higher. You know, another sign that there's just underlying weakness here. So yeah, that's just, yeah, it's just one of those things where conflicting signals at the minute. The market looks frail and vulnerable, but price action up until this point suggests the opposite. It suggests that we just keep pushing, we just keep pushing higher and higher and higher. So let's come down to the daily time frame and see what we can see. Now, here's some more conflicting signals. So on the daily time frame, we had divergence right here between a series of lower highs, while we had a series of higher highs on the day time frame. So we had bearish divergence going all the way back to July earlier this year. Then we had a lower high, then we had a lower high. So similar to 2018, but over a smaller period of months rather than years, we've had a series of lower highs in the RSI, a series of higher highs in price, but it's minimal. It's not a convincing divergence. It's just teeny tiny levels lower. It's not convincing in the same way as it was on the yearly scale we looked at earlier. Also, we've gone from overbought to oversold during this move down, and now we've got bullish divergence at the bottom. So let me show you what I mean. Let's bring up the MACD again. Sorry, the RSI. Excuse me. So yeah, we've got divergence here between this low and a higher low here. Right. Whereas in price, you'll be aware, we've got a low and a lower low. So that's a bullish sign that we're reversing, that a reversal is coming. But is it a temporary correction before heading lower, or is it a bottom? As I pointed out with the Elliott wave count, it doesn't look particularly, convincing as an impulse. It doesn't look particularly impulsive. Now on the MACD also, we've had what looks like a completed wave of bearish momentum here. We've come back below the zero bound on the daily time frame, deep into territory we haven't been to since October last year, or September last year, 2020, and we've had this move down and then move back up, move down, move back up, move down. So we've just done a significant move down. We've just turned back to green bars on the histogram. So now are we going to have another bullish phase in here before coming back down again? So there you go. I think now that I've talked myself into it, while that pitchfork holds, okay, while the market geometry holds, while we continue to set higher highs, higher lows in the RSI, and now we've had a crossover of the the average over the signal on the MACD, I think we have to assume that we're heading back up and that we're done. But if that's the case and this is a zigzag, then the wave degree is wrong. So I'm going to have to go back and recount this and downgrade the wave degree. But that's only the case for as long as these lows hold. Okay, so that's the only focus we've really got at the moment. We've got this little gulf here in the volume profile. It's not massive, but it could be enough to just try and push lower to try and find some support somewhere else. So while these lows hold and we continue to move high and continue to have bullish momentum, we should remain with a slightly bullish bias back to the upside. Okay, but if these lows break and we have a flush down and we have a rollover again of momentum, and the signals we're seeing on the longer time frame on the monthly chart start to play out on the weekly and then on the daily, I think that if we break these lows we're going to push even further. If so, we could be looking for a parity move of the W to the X to the Y, and that could bring us down to the 200-day moving average, and that would be a pretty significant sell-off at that point, and that would bring us down potentially 10%. That would be correction territory according to the media, right? Now 10% correction at this point, if the count's correct and this is a wave 4 and it is a double zigzag, that's a buying opportunity that you're kind of obligated to take. I think you'd be waiting for an impulsive move off of the low, a pullback, get in, and then off you go into that wave 5. And then you only really have to start being on guard as you approach the top of the 3, because we know that the 5 could finish at any moment from that point. I think it would press on higher. This is all pure speculation until we see any of this happen. Alright guys, I've been waffling for a fair old while now, so hopefully I haven't bored you, but it's over half an hour now. I just wanted to cover all of those things today because you can see how sometimes things aren't as simple as they appear, or as clean or as easy as they appear. And price action over the smaller time frames, you don't always get what you want. So anyway, I hope you've enjoyed that. If you're new to the channel and you like what you've seen, please subscribe, smash the like button, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below if you want to. And thank you as always to my Patreons. Your support is greatly appreciated. And if you're interested in joining the Patreon, there's a link in the description below. Head over, have a read of the tiers, see if there's anything that you're interested in. And also, if you're not following me on Twitter yet, there's a link to my Twitter feed in the description below also. Alright guys, take care, and I'll be back with you shortly. All the best. Bye bye.